Hey everyone, and welcome to this week's edition of the Swyftx Squawk. I'm Pav, lead market analyst here at Swyftx, here to bring you insights for another week on how to view the markets, looking back at this week and looking forward. And we have seen across the last 2 to 3 weeks, a lot of digital assets, they've pulled back. You look at something like Bitcoin, Ethereum, we're back to price levels that we haven't seen since about February, March this year. But there has been some outliers in the market. It's not all just doom and gloom. We have seen hyperliquid reach into new all-time high territory. So this may come as a shock to a lot of people, a bit confused. How can an asset, if we're in a bear market, be at an all-time high? If you're interested in learning more, we're not going to cover it today, but recommend you go check out our podcast, Tapping into Crypto. You'll find us on Apple Music, Spotify, and YouTube, where we go all into a lot of the fundamental factors with this one. And this is a really interesting case study of what successful crypto projects may look like in the future. It's not a guarantee, but there are definitely some traits that are very different about something like hyperliquid compared against the rest of the market. But this week, we're going to talk more about the macro. It's been a while since we've stepped back and look at the whole market holistically, away from just the digital asset space. And I want to dive into why Kevin Warsh taking his seat as the new chairman of the Federal Reserve Board may be a much bigger deal than what we're seeing in the media right now. It's been crickets. Now, one of the key things that we spoke about a couple of months ago with the Squawks was the idea that consumer sentiment, it's at lows. In fact, some serious lows. So significant, they're even lower when you look at a composite chart like this one here from the Federal Reserve Bank of St. Louis. In 1980, we saw a reading of 55. We're currently sitting at a reading of 53. Consumer sentiments, they're just surveys, but they're basically asking people to judge how's their current economic position, how safe do they feel currently, how big of an opportunity do they think that they have personally and they think the country has for economic growth as well. So the average consumer, while we have seen potentially things like equity markets move higher, the average person doesn't really feel like they're winning right now. And when we have seen a lot of the issues over the last 2 years with the trade war last year, that having an impact on users effectively paying more tax. And then we had the issues with the supply line disruption just this year as well, right? So there's a lot of reasons that your small business owner, your medium business owner, just your everyday worker, maybe potentially not in that great of a position, especially with inflation starting to peak and run away. If the consumers aren't doing too well, historically, we would also see potentially unemployment start to break. And this is where, if we go back to this whole narrative of a new Fed Reserve chair, or the committee there, they're responsible for economic policy, which is meant to do two things: maintain employment and growth, but also manage inflation. So you have this kind of tightrope that they're always walking constantly. And what's been obviously of most concern right now is that we are seeing consumer sentiment data show us that everyone's basically not feeling too great, very pessimistic on the outlook. But we've also seen inflation really not improve at all. We've actually, in fact, seen it tick up in recent weeks and months. So it kind of sets up this scenario of, okay, for them to help the consumer out would require reducing, let's say, interest rates. But the pathway to reducing interest rates is getting inflation down, which we've now seen. It's a lot stickier than what we anticipated. And again, this whole idea of the consumer not really doing too well now, it's not just for the US. Even in Australia, we're seeing rates go down to 5-year lows. It's an across-the-board issue, right? And when we're talking global markets and global assets like cryptocurrency and digital assets, for the market to do well, it has historically coincided with times that the market's been confident. The consumer's been confident about their outlook on the market and themselves and their own personal situations. At the end of the day, investment markets require people to basically put money aside to invest, looking forward for a brighter future, right? So when you take that all away, really starts to show that for things to potentially improve for the consumer, really some assistance on that frontline interest rate or the headline interest rate that we all receive could be one of those key ways that they could toggle. But when we look at the short-term interest rate markets in the US, now this is looking at implied rates. So essentially the federal funding rate is an open market. So we can go to something like the CME, which is an exchange, and look at the futures contracts to understand how is the market perceiving what the road of interest rates are going to be moving forward. And it gets priced in month on month across this curve. And this isn't predictive of what's going to come, but it essentially is a framework of how the market sees what's coming. And the short takeaway here is they're expecting no rate reduction, right? No rate reduction. And if anything, over time, a potential rise in interest rates into towards the end of next year. So again, you've got a pessimistic consumer, lower than we've seen ever. When we look at this composite survey chart, it's not really particularly tied to just the US. We're seeing it as a bit of a global trend, even here onshore in Australia. And again, you have someone who's been picked to come into a position where maybe the expectation is for a rate cut. And it really seems like a bit of a vertical challenge, right? When the whole market is expecting the opposite. And that's the takeaway for the squawk today. While we are seeing things potentially look like how could they possibly make room to cut, at the end of the day, like if things are as bad as they've been for the consumer over the last, let's call it 40 years almost, it may require an adjustment of what we would consider normal, right? While we all normally may expect inflation needs to come down before policymakers are going to reduce rates, and that's been very clear in a lot of the statements that's been made by the previous Fed chair. You can go back and read those if you like, but we've talked about them on the Squawk as well in previous months. Maybe this particular policymaker coming in, Kevin Walsh, has got a different idea. And I've done some personal homework on him as well. He does have some pretty interesting views on things. He's very charismatic, very easy to listen to, very compelling. But yeah, it's going to be interesting to see if that when coming into the position, he's going to hold the same views that he had looking for a nomination for the position. He was very much of the idea that let's shrink the balance sheet, so let's reduce the amount of assets that the government's holding, but that also allows us to reduce interest rates as well. So it seems like the market right now isn't quite buying this idea that we could still see interest rate drops. But again, consumers not doing too well. Interest rates are a way to take that pressure off and ease that burden. And it's going to be a really interesting period of time, especially since if we look at FedWatch, which is a tool that everyone can access, we're still 19 days away from the next meeting. So this will be the first time that we see the new Fed chair come in and basically give his statement and basically make their positioning known on where they see the economic policy needs to move to, given the current landscape out there right now. So it's going to be very interesting to see. As right now, yeah, again, like we've talked about, the market's not expecting any changes in interest rates, at least in the near term. And again, just to bring this back to crypto, why does this matter? Again, all these things, they could overlap a little bit. Everyone can probably think about their own personal situations. If they want to put more money into the market, it's got to come from somewhere. So unless everyone's making more money elsewhere, interest rates are a way for people to have lower obligations on things like home mortgages and debt repayments and things like that. So it does open up a bit more capital to come back into other places for growth. So it's going to be very interesting to watch this space. But that's it from me here at Swyftx. We'll catch you again next week. Cheers.